You can now get monthly dividend income from one globally diversified ETF. If you've ever tried to find a fund that pays monthly, you'll know almost nothing does without a catch. Funds either sacrifice capital upside, include bonds, or simply aren't diversified enough. That was until January this year, when the LDGG Global Quality Dividends ETF launched, yielding around 3.7% and paying out every month. So in this video, I'll show you exactly how it picks its companies, what makes it different to every other dividend fund for UK investors, the honest downsides, and whether you actually need this type of fund in your portfolio. Getting monthly income outside of a salary can be a tricky task, especially from dividends, as most companies pay out either quarterly or semi-annually. There's plenty of funds that use bonds, covered calls, or real estate strategies to be able to pay monthly, but they're either for a different purpose or their trade-offs are not worth it. This fund is different because it's a normal broad index fund that pays monthly. I'll get to how it's able to do that later, but it's called the LDGG Global Quality Dividends ETF with the ticker LDGG. It charges 0.29% a year, and the distributing version pays out around the third week in every month. There's also an accumulating version if you'd rather the income was reinvested. The index it tracks is the FTSE Developed All Cap Dividend Growth with Quality Index, which has a very specific selection criteria. It starts with the FTSE Developed All Cap Index, which is essentially the whole developed world stock market, currently around 5,400 companies. From there, a few things get removed straight away. Real estate investment trusts are out, loss-making companies are out, and there's an ESG screen, so companies involved in controversial weapons or thermal coal are excluded, along with companies flagged for breaking UN standards on corporate conduct. Then come the two tests that give the index its name. The first is dividend growth. The index looks at how each company's dividend has trended over the last 10 years. A company doesn't need to have a perfect record, just as long as the direction is trending up, which isn't quite as strict as other dividend indices, such as the Dividend Aristocrats, which demand 10 consecutive years of increases. The second is yield. To get in, a company's expected dividend yield over the next 12 months has to sit in the top quarter of all those companies. So you're only ever picking from the high yielding end of the developed world. On top of those two, there's a quality screen. FTSE score every company on their standard quality measures, things like profitability and the strength of the balance sheet. And the weakest scorers in each industry get removed. It's equally weighted rather than market cap weighted, but there's a cap, so the very smallest companies can't be handed more money than they could realistically absorb. The whole thing then resorts itself twice a year in March and September. Put that all together and you've got 956 companies, with the biggest single position currently Lenovo at 0.45% of the index. The top 10 holdings account for just over 3%, so there's no single company concentration risk. Where there isn't quite the same level of diversification is in the sectors. Because companies are selected on yield, financials end up around a third of the index and industrials are around 20%. Technology, by comparison, accounts for less than 4% here. The index only launched in February 2024, but uses a base date of March 2009, which means it can measure performance back to that date using back-tested data. A lot of new indices tend to do this, with the idea being it gives investors a sense of how the rules would have played out in the past. A rules-based backtest like this is in theory more trustworthy than an active approach because there's no discretion in it. The formula does what the formula does. But there's two things to be cautious of when looking at backtested results. First, these rules were written by people who already know how the last 15 years went. And second, that base date is very convenient as it's within a couple of weeks of the bottom of the financial crisis crash, making it about the best possible time this century to start measuring performance from. This is very common though. I spent 10 years in asset management and I never saw a product launched off the back of a bad backtest. But based on that, it's performed extremely well in the last few years. Always look at the net tax line as it's after withholding taxes. It's returned 11.1% on average over 5 years and 18.4% on average over the last 3 years. Those figures are with income reinvested. What's interesting is how similar it is to the FTSE Developed All Cap Index over that period. Very different methodologies, but ending up with similar total returns. But perhaps one of the biggest attractions to the LDGG fund is that it pays out the income monthly. And while that can certainly be useful, there's an important caveat you need to be aware of. The payment isn't simply whatever the portfolio earned that month. LDGG decide the amount. You'll see the previous amounts have been exactly the same, 3.53 cents a share. Of course, a portfolio of nearly 1,000 companies doesn't earn its income that evenly, so the smoothness is by design. If we look at the fund supplement from their website and go to page 6 under dividend policy, it says the company intends to maintain a stable rate of dividends on the distributing classes of shares. Stable dividend rates are set using the historical dividend yield of the fund's holdings attributable to the distributing classes of shares and forecasting a dividend yield for the fund to be distributed on a monthly basis. That's them saying how they set the rate the fund will pay out. In terms of how they keep it stable, that's answered on the page before, where it says the fund may make distributions from capital as well as its net income in order to provide stable distributions to holders of shares. So there is flexibility in adjusting the rate, but the goal is to keep it stable. You may be surprised to see that if dividends coming in fall short, then they have the ability to essentially pay them out of the fund's capital. In practice, you're unlikely to notice this, and it doesn't change your total return. It's just something to be aware of. You'll also see a different dividend yield quoted depending on where you look. For example, here it's showing as 2.19%, but that's because it's only including dividends paid so far. The expected annualized yield is currently 3.7%. There's a lot going for this fund, but there's a few other things you need to be mindful of. The fund is very diversified by company, less so by sector. Financials make up a third of the fund. These have been great in the last few years, especially for yield in a higher interest rate environment, but it means it's not quite as diversified as it may seem at first. Although I should say this is quite a common theme across dividend funds right now. The dividends are also declared in US dollars, which is fairly standard for global dividend ETFs, but it means as a UK investor, the amount you receive will vary dependent on exchange rates. And the other thing is that it's still a new and fairly small fund. The AUM is around $388 million, which isn't bad. It just means compared to some of the other mainstream dividend funds, it could have a slightly wider spread at times. That's the difference between the buy and the sell price. This will become much less of an issue as the fund grows though. Where this fund shines is in its strict selection criteria, its diversification on a country and company level, and its steady monthly income. If it's income to live on, it also means you need just one fund, so you don't have to worry about finding multiple funds with offset payment months. What you've got to ask yourself is how important are monthly payments to you? I get why it's popular. For most of your life, you've received a salary every month, and most bills are also paid monthly. But really, with a quarterly paying fund, it's really just a cash flow adjustment and maybe holding a slightly bigger cash buffer. And if you're reinvesting the income, then the frequency is irrelevant. For me, it comes down to the quality of the index and its selection process. I'm a big fan of dividend investment trusts, especially the dividend hero ones. These are the ones that have maintained consecutive dividend increases for decades. City of London is now on 60 years. And if smooth income is the goal, they can use a revenue reserve to hold back up to 15% of their income in good years to pay out in the not so good years. But because they're quarterly paying, if you wanted monthly payments, you'd have to find 3 trusts with offset months. LDGG is for people who want the most hands-off approach in the simplest form. Give me my monthly income and forget about it. It also combines well with the typical global index fund because it has hardly any tech stocks, and because it's equally weighted, every holding is a tiny percentage, so there's very little overlap. If you're wondering whether just holding one global ETF in your portfolio is enough, then watch this video next. Thanks for watching. I'll see you in the next one.